There's a sentence your parents taught you before you could ride a bike. Put your money in the bank. It's safe there. You believed it. I believed it. 209 million American depositors believed it. That sentence was the foundation, the bedrock, the one thing in this chaotic economy that was supposed to be unchallengeable, unbreakable, beyond question. And on March 10th, 2023, it broke. Silicon Valley Bank didn't die the way you'd expect a bank to die. There was no slow bleed, no years of warning signs flashing across cable news, no congressional hearings before the fall. It was Thursday, then it was Friday, and then 42 years of banking history became a footnote, erased in 48 hours. $209 billion in assets. Gone. Not in a war, not in a depression, in a weekend. I remember watching the footage. Startup founders, people who had spent years building companies, standing outside SVB's headquarters in Santa Clara with this look on their faces. Not anger, not yet. Something worse. Confusion. The kind of confusion a child shows when they realize a parent lied to them. These people couldn't make payroll. They couldn't pay rent for their offices. Some of them couldn't pay their employees who had mortgages due, who had kids in daycare, who had medical bills stacking up like firewood before winter. And the FDIC logo was still on the door. That logo, you've seen it 1,000 times. That little emblem at every bank teller's window, on every website, printed on every statement. Each depositor insured to at least $250,000. It's financial scripture. It's the reason you don't stuff cash into your mattress. It's the reason the entire modern banking system functions, not because of math, not because of regulation, but because of belief. But here's what no one tells you about belief. It doesn't need to be true. It just needs to hold. And in March 2023, it stopped holding. Signature Bank fell next. 2 days later, $40 billion in assets, swallowed. Then First Republic, limping along for weeks like a wounded animal before JP Morgan Chase absorbed its corpse in May. 229 billion more, consumed. 3 banks, 72 days, combined assets exceeding $500 billion. That's more than every bank that failed during the entire 2008 financial crisis. Combined. Let that settle for a moment. Not a single year of the Great Recession produced the asset value destruction that one American spring did in 2023. And yet, do you remember the headlines? The system is sound. This is not 2008. These were isolated incidents. Isolated. I've heard that word before. Every generation hears it, right before the floor disappears. So I started digging, not into what happened. That story's been told. I started digging into why it keeps happening, why this pattern, this exact sequence of shock, collapse, and reassurance has been repeating for over a century. And what I found was not comforting. Here's the thing about a trap. The best ones don't look like traps. They look like opportunity. Silicon Valley Bank took in deposits, billions of them, from tech startups flushed with venture capital money. And what did they do with that cash? They bought the safest assets on the planet. U.S. Treasury bonds, agency mortgage-backed securities, the kind of instruments your financial advisor calls risk-free, the kind the textbooks tell you to hold when you want to sleep at night. SVB did everything right, on paper. But paper doesn't survive fire. Here's the mechanism. When the Federal Reserve held interest rates near zero for years, SVB loaded up on long-duration bonds, 10-year maturities, 20-year maturities, bonds that lock your money away for decades and pay you a modest, predictable return. Safe, boring, institutional bedtime stories. Then the Fed did what the Fed always eventually does. It raised rates, aggressively, 450 basis points in roughly 12 months, the fastest tightening cycle in 40 years. And when new bonds start paying 5%, who wants your old bond paying 1.5? Nobody. The market value of SVB's portfolio collapsed, not because the bonds defaulted, not because America stopped paying its debts, simply because newer, better-paying bonds existed. This is called duration mismatch, and it is the oldest killer in banking. But there's a second blade: deposit concentration. 93.8% of SVB's deposits were uninsured, above the FDIC limit. That means the people holding money there, founders, CFOs, payroll managers, had every rational reason to run at the first sign of smoke. And they did. $42 billion fled the bank in a single day. One day, that's roughly $1 million every 2 seconds. No vault is deep enough for that. Signature Bank, same disease, different patient. Heavy exposure to crypto depositors, volatile, skittish, digitally connected. When confidence cracked, withdrawals didn't trickle, they flooded. First Republic, wealthy clientele, large uninsured balances, rate shock eating the loan book alive, same pattern, same grave. Now, and this is where it gets uncomfortable, this mechanism is not new. It is not a 2023 invention. The panic of 1907 was triggered by concentrated deposits fleeing trust companies after a failed speculation scheme. The savings and loan crisis of the 1980s, interest rate shock, institutions that had locked in long-term, fixed-rate mortgages got annihilated when Volcker pushed rates to 20%. Duration mismatch, the same weapon, the same wound, over and over and over. Different decades, different presidents, different technologies, identical autopsy reports. If this pattern disturbs you, it should, because I'm not done showing you how deep it goes. And if you don't want to miss the part where I show you what the data says is coming next, subscribe now. Hit the bell, because the algorithms bury this kind of content, and I refuse to let it disappear. The mechanism is clear. The question is, why does no one disarm it? That answer is worse. They knew. Every single time, they knew. After the panic of 1907, Congress created the Federal Reserve. The explicit purpose? Prevent bank runs, provide liquidity in a crisis, be the lender of last resort so that terrified depositors would never again stampede toward a locked door. Problem solved, system stabilized, history defeated. 16 years later, over 9,000 banks failed. The Great Depression didn't creep. It detonated. Between 1929 and 1933, American banking didn't just bend, it disintegrated. 9,096 banks. Gone. Exposed deposits. Shattered families. Men who had saved for 20 years, who had done everything the system told them to do. Work hard, deposit your wages, trust the institution. Standing in breadlines by Christmas. Their savings didn't shrink. Their savings ceased to exist. So, what did they do? They created the FDIC in 1933, Federal Deposit Insurance, the ultimate safety net. Never again would ordinary Americans lose their money in a bank failure. The logo went on every door, The promise went into every mind. And for a while, it held. Then came the 1980s. The savings and loan industry, over 1,000 institutions, bled out over a decade, 1,043 failures. The cause? Interest rate shock and reckless deregulation. The government had loosened the rules, let S&Ls chase high-risk investments with federally insured money. When the bets went bad, taxpayers absorbed $132 billion in losses. A mother working night shifts at a hospital in Ohio paid for a real estate gamble she never knew existed. So they passed reform. The Financial Institutions Reform, Recovery, and Enforcement Act of 1989. New oversight, new rules, tougher capital requirements. Never again. You know what comes next. Washington Mutual. September 2008. $307 billion in assets. The largest bank failure in American history until 2023 surpassed it by sheer cumulative destruction. WAMU had gorged on subprime mortgages, lending to borrowers who couldn't afford the homes they were signing for. And the regulators? They watched. Some of them even encouraged it. Do you see it now? The rhythm? Crisis, reform, confidence, complacency, crisis. It's a heartbeat, and it never flatlines. It just pauses long enough for you to forget the last cardiac arrest. Here's the part that keeps me up at night. After 2008, they passed Dodd-Frank. 848 pages of legislation. The Volcker Rule, stress tests, living wills. The most comprehensive banking reform since the Depression. Regulators stood at podiums and said the words we've heard after every catastrophe. The system is now resilient. 15 years. That's how long the resilience lasted. In 2018, Congress rolled back key Dodd-Frank provisions for banks with assets under $250 billion. Silicon Valley Bank had $209 billion. It slipped right under the wire. Stress testing requirements relaxed, enhanced oversight removed. The guard dog was put to sleep, and the wolf walked through the front door, wearing a government-issued collar. Nobody screamed. Nobody ever screams until the floor is already gone. So, here we are, standing in the wreckage again, asking the same questions we asked in 1933, in 1989, in 2008. How did this happen? Who was responsible? What are we going to do about it? And I want to be honest with you, I don't think those are the right questions anymore. The right question is simpler, and it's terrifying. What if this is how the system is supposed to work? Not broken, not corrupted, not poorly regulated, functioning. Functioning exactly as designed. A machine that concentrates risk during calm years and distributes consequences during chaos. The profits flow upward in the sunshine. The losses rain downward in the storm. And between each storm, just enough reform gets passed to rebuild the belief, to patch the faith, to get 200 million depositors to whisper again, "My money is safe." Look at the data, not the headlines, the data. Since the FDIC was established in 1933, over 3,700 banks have failed in the United States. 3,700. That's not a series of accidents. That's a statistical pattern with a pulse. That's a system that metabolizes failure as fuel. Small banks get consumed. Large banks get absorbed. The biggest banks, the ones deemed too interconnected to be allowed to die, they get fed. JP Morgan Chase absorbed Washington Mutual in 2008. JP Morgan Chase absorbed First Republic In 2023, the same predator, 15 years apart, growing larger with each crisis. After the First Republic acquisition, JP Morgan's total assets exceeded $3.7 trillion. Trillion. One institution now holds more financial power than the entire US banking system did in 1990. Does that sound like a system that discourages failure, or one that rewards it selectively? I want you to sit with that for a moment. The pattern isn't a warning. The pattern is the product. Every cycle concentrates power further. Every collapse thins the herd of smaller competitors. Every reform creates a temporary flaw, just stable enough for the public to redeposit, reinvest, rebelieve, before the next deregulation cycle opens the wound again. It is not a circle, it is a spiral, and with every revolution, the institutions at the center grow denser, heavier, more gravitational, more inescapable. And the depositor, the small business owner wiring payroll through a regional bank, the retiree with a savings account 2% above the FDIC limit? They are not participants in this system. They are raw material. So what do you do with that knowledge? I don't have a clean answer. I wish I did, but I can tell you what I've done. I've stopped believing in the logo on the door. I've started reading quarterly call reports the way you'd read a survival manual, not for interest, but for self-preservation. I've diversified not just across assets, but across institutions, across jurisdictions, across assumptions. Because the next failure isn't a question of if. The FDIC's own problem bank list, which they publish quarterly, contained 43 institutions at the end of 2023. 43 banks sitting in a waiting room that nobody sees. And the pattern has never once, not once in 116 years, failed to complete its cycle. Sleep well.